Good morning to everybody. There is still some places here on my right-hand side for the people who are standing there. Okay, let's start. Ladies and gentlemen, good morning and welcome here at our, let's say, first international conference after a very, very long time organized by Insurance Supervisory Authority. I would like to thank you that you participate in such a great number. We were expecting about 150 people and now here you are 225 by last count, so I'm very happy for it. This is a reason because of this reason you will be slightly more, not so much comfortable, but I believe it's worth spending a day in such a big crowd. Then I would like to thank especially our distinguished speakers, which we have from all walks of insurance life. We have people from Slovenia, from European institutions, from other countries. We have people speaking from the industry, from the supervision, policymakers, consultants, and of course representatives of the consumers. We have Minister of Finance, who is the apex of the financial industry, and he basically all the interests gather at his table sooner or later. Our main themes, our main subjects, which we will try to tackle today, is of course the focus on the Solvency II, or risk-based approach to supervision. This is not only some formal shift from one approach to another approach, like amending or changing the law. It's a mental shift. It's the biggest change since the regulation of insurance started in Europe. It's a big conceptual challenge to go from the rules-based approach to the principle-based approach. And if you are making such a huge step, this is also associated with a lot of risks. We are going to assess differently, we are going to interpret differently different concepts which will arise, such as strategy, risk appetite, the role of governance, etc. And these risks are not arising only out of complexity of the problems. We are replacing rules for models. And here the problem lies also because now we have rules. If we just tick the boxes, then we feel that we are compliant. And now we have the models, which we believe are again perfect, and we put some information into models, and what comes out is also objectively true, like what was before in the law. So we should try to avoid this trap. The role of corporate governance as I would say, the core of all the processes in an insurance undertaking. We will have long discussions about what principle-based means in theory and in practice. What is strategy? What is risk appetite? Who is responsible for formulating the strategy and the risk appetite? Who is going to be the person who is going to sign under what is risk appetite of a particular enterprise? The program itself will start with the Slovenian Minister of Finance. Then we will continue with the first keynote speaker, the man whose report bears his name and whose report is basically a start of risk-based approach on the European level or on the Commission level in Europe from 2002. This is, of course, Paul Sharma. Our second keynote speaker, just after lunch, is the man who is responsible for the implementation of Solvency II on the European level. He is the risk-based supervision guy on the European level, Mr. Gabriel Bernardino, the chairman of EIOPA, of European Insurance and Occupational Pensions Authority. Then we will continue with three panels. The first, a general one on the risks associated with the risk-based approach, Here I'm listed as that I will chair the panel. Unfortunately, I will have to excuse myself because I have to do the same thing basically in Slovenian Parliament today at the same time, but my colleague Mojca Piškorić will more than adequately replace me. Here the discussion is going to be more general about concepts. After the lunch, after the second keynote speech, we will continue with the issues related to the governance. And here we will endeavor to make a shift from very general views to particular issues of governance in risk-based approach, as we do believe that governance lies really at the center of any business enterprise. And finally, we will end with panel on market conduct risks. Why? Because traditionally, market conduct issues have been treated very separately from the prudential issues. But we do believe that if we are talking about all-encompassing approach to the risks, market conduct risks is the example which should be taken into account on all the three levels of all the three fields where the risks can have impact: on direct to the consumers, to the insurers on the prudential level, and on the systemic level. So the final session will be basically wrapping up general views with very concrete problems we have in market conduct. Finally, some my personal remarks about such event or this particular event. This change in the regulation, it's, as I said, it's not only we will have to read a different law, it's about a mentality change. We will have to have a different approach to the business as we see it. You will have to have the different approach in the industry. We, in the supervision, will have to have a different approach to the business we are supervising. This will require much more what we are calling supervisory dialogue. We will have to be in constant touch with the industry. On one hand, we will have to understand the business model the industry is running. We'll have to understand the risks arising from the business model. And it's only in dialogue that we can understand them. And the industry will have to understand what are our expectations in accepting such risks, and what is our limit of tolerance to which the corporate structures can go. I believe this is a process. I believe we have very divergent views on particular issues. And it's not only a question of controversy, but I remember from the last EIOPA conference, the audience has been asked, where do you see the biggest challenges? And all the industry was saying in ORSA, and all of the supervisors were saying in market consistent assessment of assets and liabilities. So we see different problems, we have different challenges. But I believe such fora as this conference is an opportunity to start this, I would say, productive conversation. And just finishing with the conversation, I believe conversation is about different views. Different views are by nature controversial. I hope this event today will be controversial. I do not wish it to be politically correct. I would like to hear different views, because there is no black and white. We are talking about concepts, and different concepts can have different interpretations. And this is about it. Last but not least, my final thought is that complexity of Solvency II, in the complexity of Solvency II, we might easily lose the focus. We see the trees in their most minute details. We see the structure of the leaves on the trees, but we tend to forget to see the forest. While tackling those difficult and complex issues, we should never forget that the ultimate goal of the Solvency II project is the protection of consumers of insurance services, in particular, and of the citizens of the European Union at large. With this, I would finish, and I would really invite the Minister of Finance, Professor Dr. Mramor, to replace me here. Thank you.
Dear ladies and gentlemen, it's a real crowd, I must say. Fantastic. Actually, there's such an interest in Slovenia and abroad for this conference. It must be the right moment when it is organized, and the topic is, there, without doubt, the right one. But let me say a few words before I conclude this speech with a message. As you probably all know, the insurance business is an old one. According to history books and Code of Hammurabi, Babylonian traders paid the lender an additional sum in exchange for the lender's guarantee to cancel the loan should the shipment be stolen or lost at sea. It is also a business that arises from the need. The roots of the property insurance as we know it today can be traced to the Great Fire of London in 1666, way back. Even though insurance business is an old business, it is a business that changes with time, and rightly so. As a wise man named Bob Dylan, if you remember him, once said, "You better start swimming or you'll sink like a stone for the times that they are changing." And indeed, in the past, there were many changes that shaped the insurance business, and today we are facing new ones. The first major change is the introduction of Solvency II regime. It can probably not be compared to the discovery of Pascal triangle, but nevertheless, it will change the way insurance companies conduct their business. As almost everything has already been told about Solvency II, and as you probably know it better than I do, I will only say that I strongly believe that Solvency II will benefit us all, as the calculation of regulatory capital will be based on actual risks of a respective company, and as the number of supervisory tools will be increased, the policyholders will be safer, supervisors more efficient, and insurance companies more stress resilient. The introduction of new regulatory requirements is not the only change that the insurance industry is faced with. The all-encompassing technical development will have a major impact on insurance products. For example, currently autonomous cars are being developed not only by almost all major car companies, but also by Google. Although it may take a couple of decades for the market to feel the full impact of robotic cars, the implication of emerging technologies, such as already existing automatic braking, will have to be taken into account when creating insurance products. However, the technical development does not only influence the types of insurance products, it also determines how probabilities are calculated. As technology advances, companies are starting to use new advanced modeling techniques. When talking about changes, we should not forget about the changes in demographics. The insurance companies, as well as the rest of us, are faced with the fact that there is no escaping from the fact that we are getting older. This may be a bad news for us, but for the insurance companies, this may create an opportunity as the limitations of traditional pension schemes steer consumers to insurance products. Furthermore, the changes that challenge insurance companies also arise from other financial sectors. For example, insurance companies always have to adapt to ongoing market developments. Even Solvency II reiterates this, as a market risk is a risk that is included in its formula. I have not listed all changes that the insurance companies will be faced with. It is impossible. But all those changes should be taken into account when examining the strength and resilience of an individual insurance company. There I hope that Solvency II, with its risk-based capital requirements and three-tier structure, will turn out not only as a change, but also as an answer to the torrent of future changes. Or to paraphrase the above-mentioned wise man, I hope that Solvency II will be one of the swimming tools that will help us to swim through the sea of change. I would like to share with you also some information about the current state of transposition of Solvency II into Slovenian legislation. Solvency II will be transposed into Slovenian legislation with the new Insurance Act. The proposal of the Insurance Act was approved by the government of the Republic of Slovenia on 24th of June this year. Currently, it is in the second reading of the legislative process in the National Assembly of Republic of Slovenia. What are the benefits of the new regime which will be implemented by new Insurance Act? The aim of the new Insurance Act is to improve the risk management of the insurance and reinsurance companies. The current legislation is not sufficient in this respect. Therefore, the new Act regulates incentives for the insurance companies to think about qualitative aspects that influence their risks, like leadership skills, internal controls, and consequently improve the risk management. The new Act also enables better distribution of capital resources, which will have great impact on the investment strategies of the insurance companies. The new Insurance Act also aims to improve the convergence of the supervision and the cooperation of supervisory authorities. One of the basic ideas of the legislator is that insurance activity should also be aligned with other financial activities in respect of legislation and supervision. Only in this way the supervision of financial conglomerates can be effective and successful. Furthermore, the new Insurance Act also prompts a transparent regime which can only give the right results and ensure better understanding of the situation in which the insurance companies are. Generally, considerable benefits are expected from the new Insurance Act for all interested parties. The new Insurance Act will result in much greater emphasis being placed on sound risk management and robust internal controls. Supervisors will obtain better supervisory tools, enabling more timely and effective action, as well as powers to conduct comprehensive reviews of all the risks insurance and reinsurance undertakings face. However, it is important to stress that the main direct beneficiaries of the new regime will be insurance policyholders. Ladies and gentlemen, thank you for your attention. At the end, I would like to wish you successful exchange of views on all challenges posed by the implementation of the new regime, and that you together find effective answers to them. And concerning this title behind me, What Can Go Wrong? I would like that this conference turns around a bit and comes with answers how to approach this change that everything goes right. Thank you.
Thank you and good morning. I'm Paul Sharma and I'm very grateful to be invited to speak to you. You have the opportunity of hearing from me twice. There's this 20-minute keynote address, and I will stick strictly to 20 minutes because I'm what's separating you from your morning coffee break. And then after the break, I will be speaking on the panel from a point of view of practical help for you as to how to implement Solvency II. But before the break, I want to give something more of the big picture. As Sergei said, I was one of the pioneers of Solvency II, along with Gabrielle. We're Solvency II veterans. I authored one of the early reports that was important in the creation of Solvency II, and then for many years chaired the Pillar 1 group of what was CEOPS at the time, and then after that chaired the Internal Models group on Solvency II. Now, how is Solvency II going to change the world? That is the thing I want to talk about. How Solvency II is going to change everything, probably. Let me first of all answer a little bit to the title of the conference, What Can Go Wrong? And just make the historical observation that changing from an old regulatory regime to a new regulatory regime, however good the new regulatory regime is a point of maximum danger. I'll repeat that. Changing from an old regulatory regime to a new regulatory regime, however good the new regulatory regime is a point of maximum danger. And I cite two examples. Forgive me from the banking industry. It's so long since we changed regulatory regime in the insurance industry that you know, I'd need to talk to my grandfather for an example there. In 1989, we saw the introduction of Basel I. Basel I. That coincided with the collapse, meltdown, call it what you will, of the Japanese banking industry. Basel I, one of the main causes Basel I was introduced, was negotiated in the 1980s, was a fear about the strength of the then strength of the Japanese banking industry and the potential for bad loans, and the introduction of the regime in order to prevent that risk, in many respects, crystallized that risk. Then, in 2007, 2008, we saw the move from Basel I to Basel II. Now, in no sense did the move from Basel I to Basel II cause the global financial crisis. However, that introduction was an important contributive factor to that crisis crystallizing at that particular time. A number of things happened. I don't have time to talk about all of them, so I'll just mention one. Banks, at precisely the point in time that they needed to be most focused upon their regulatory and risk positions, banks were confused by the switch from the old metric to the new metric. They didn't understand, they didn't have a track record of watching their Basel II numbers. And so when the Basel II numbers first started to come in, they didn't really understand them, perfectly understandably. And equally, they regarded the Basel I numbers with a degree of correctness as being essentially now irrelevant. That loss of control, the confusion that occurs when one switches from an old regime to a new regime, where the new regime isn't really in any sense a sort of successor to the old regime, it's more a revolution than an evolution, inevitably confuses risk management, inevitably confuses one's management of one's companies, and it inevitably takes time to understand the new regime. Unfortunately, that switch happened in the case of Basel I to Basel II at precisely the time when the industry needed to be most focused on their risks. The switch from Basel II to Basel III, I think, is going a bit better. It helps that it's being phased in over a longer period of time. But we very much look for the switch from Solvency I to Solvency II to teach the bankers how to do these sorts of things, now that we finally have an opportunity to do so. Now, how do I think Solvency II will change everything? Well, let me say, I think in financial services, we're seeing a profound disruption in traditional ways of doing things. And there are two things that are disrupting traditional approaches to insurance, to banking, to investment services. The first, and I think actually the most important of which is not regulation, is new technology. The first and most important of which I think is not regulation, is new technology. And if I were to give a side message on Solvency II changing everything, don't forget, actually, there is something else that will change things more profoundly than Solvency II, and it is neither created nor by Gabriel nor myself. Perhaps if we'd made better career choices earlier in our lives, we would have been technologists and talking to you about the most important disruptor of your businesses, is instead of which we're talking about the second most important disruptor of your business. Having said that, I do profoundly believe that Solvency II does represent a significant change. And I'm focused this change in terms of its effect on the marketplace. Now, depending where you are in Europe, and depending upon which segment of the insurance market you're in, you have already seen some of these changes, or you have not already seen some of these changes, depending upon where you are. But let me run through the ones that I'm expecting. I think Solvency II is not just going to be carry on the way you are and overlay that a layer of compliance. Solvency II will change the way in which insurance products are priced. That is an absolutely profound, and they're not in a, other compliance, other pieces of government regulation change the way in which products are priced because they add a uniform layer of cost on everything. Yeah? No, okay, so the administrative burden of Solvency II will add a uniform layer of cost on everything, but that's not the change I'm talking about. That's the less important change. Solvency II will more profoundly change pricing precisely because it is not the same approach as Solvency I in any sense as to how much technical provisions and how much capital you need to hold in respect of which types of insurance risk. It will change the important thing in pricing is relative pricing, and the important thing in Solvency II is that the relative financial resources requirements from one type of business to another, from one way of expressing a promise to your policyholder as compared to another way of expressing a promise to your policyholder changes. I've mentioned three particular things. Just let me, time being pressing, talk a little bit about the last one. Insurance products, particularly life insurance products, have been a traditional home to long duration, deeply out of the money embedded options given to policyholders. Life insurance products in particular, have often included long duration, deeply out of the money embedded options given to policyholders. Traditional techniques have often seen these as almost free because they're, the option is deeply out of the money. Market consistent techniques will see these types of promises as deeply expensive. Competition across financial sectors. Regulatory arbitrage between banking and insurance. Solvency II will make that significantly more difficult because it will price risk in a risk-based and market-consistent way. However, regulatory arbitrage will not cease, not least because Basel III does not yet price risk in a consistent, risk-based and market-consistent way. In fact, one of the big differences between Solvency II and the banking regime is, to put it simply, Solvency II is coherent, and the banking regime, Basel I, II, and III, is incoherent. Solvency II is coherent, and the banking regime, Basel I, II, and III, is incoherent. What do I mean by that? I'm using these terms not just in an insulting fashion, but also in a technical fashion. There is a single idea that underlies all of Solvency II. And that single idea is the 12-month, 99.5% confidence level based upon the valuation of assets and liabilities in a market-consistent way. Now, one may argue that certain parts of Solvency II do a good or a bad job in fulfilling that idea, but nonetheless, that idea underlies everything. There is not and it is the fact there is one idea that underlies everything is the reason why I call the Solvency II regime a coherent regime. There is no single one idea that underlines all parts of the banking regime. One bit is a 99.9% 1 year. Another bit is a 99% 10 days. Another bit is goodness knows what, we can't work it out. There's a trading book and there's a banking book, and one is market consistent and the other is not market consistent. And then there's a securitization regime which quite frankly is neither market consistent nor non-market consistent. It's the perfect example of Schrödinger's cat. It's neither dead nor alive. It exists in some quantum intermediate state. And it's for that reason, it's the very incoherence of the banking regime that means there will continue to be arbitrage between the banking and the insurance sector, albeit probably quite different forms of arbitrage that occur with reference to Solvency I. Let me move on to the third, which is competition across borders within Europe. Solvency II will take a significant step forward towards a true single market in insurance in Europe. But we're not fully there yet. There are differences in taxation. But a key issue as to whether we actually really achieve that single market is the extent to which our dear friend Gabrielle tolerates differences in practice in supervision of Solvency II across one country to another. I come from the country that tries to be the most different and the most awkward on any topic you care to name, the UK. But actually, the reality of there is an opportunity in the insurance market here that has not previously occurred for at least 20 years, an opportunity actually genuinely to realise the single market in insurance, taxation accepted. That opportunity will either be seized by my former colleagues or it will be botched. If it is botched, it probably won't come again for another 20 years. If it is seized, it will be very much to the benefit of policyholders, but it will be deeply and profoundly disruptive to you, practitioners within the insurance industry. Competition beyond Europe to the world, Solvency II will create a global capital standard. I'm absolutely convinced of that. The only thing we don't know is quite in which of two ways it will do this. Way one is there's an agreement reached in the International Association of Insurance Supervisors, and there is a global capital standard for insurance that's agreed, and that will be largely based on Solvency II, but with some compromises to other points of view. Yep. That's the first way in which it will occur. The alternative is there is no agreement in the International Association of Insurance Supervisors, in which case Solvency II will become the de facto world standard. Just like everything else. Everywhere in the world, even in the UK, we now measure things in centimetres, and metres, and kilometres. The only exception is the US. Yeah. Everywhere in the world, we play football. In the US, they call it soccer, and they play this other thing that they call football. Yeah. So with the exception of the US, if there is no agreement, Solvency II will become, and is in the process of becoming, the de facto world standard. And that will have some profound implications for competition even outside of Europe. And there are some key decisions coming up on issues such as equivalence under the Solvency II regime. Finally, Solvency II and financial stability. Many central bankers look at Solvency II with fear and foreboding and say this will be a source of financial instability. Now, in addition to being an insurance supervisor, I used to be a central banker, and it's fair to say that we central bankers have not had a good past decade in terms of predicting what does or does not cause financial instability. But the fear is that market-consistent valuation will lead to volatility, and volatility will lead to financial instability. That may prove to be the case, although personally I do not believe so. I think it's possible that the introduction, the move from one regime to another regime, itself may cause financial instability, regardless of how good the new regime is. But I think once the Solvency II regime is bedded in, then the market consistent approach and the explicit risk quantification approach for the capital requirements will actually encourage insurance companies to address tail risks well in advance of them crystallizing. And if I were to take the experience of the UK here, our insurance companies in the UK did much better than our banks in the UK during the global financial crisis. Our insurance companies already had anticipated many aspects of Solvency II with near market consistent valuation. Our banks very much did not have near market consistent valuation. The latter proved to be unstable, the former much less so. But I do acknowledge that the transition, again, I acknowledge that the transition from Solvency I to Solvency II presents significant risks, and that will be the subject of the panel. And whenever you do that transition, there are risks, but let's recognize we're doing that transition in an abnormal period, in a historically abnormal period of historically unprecedented low interest rates. And it is very possible that Solvency II may crystallize problems that are already present. And it is entirely possible that as the bearer of bad news, long denied, it may well be mistaken for the causer of that bad news. Thank you for your attention.
This is one risk we were not anticipating. So and it's good we have a coffee break.